Hello and welcome along to the Property Academy podcast by Ibis Partners. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking about how to get 5 times the returns through property. And over the next 15 minutes, you can learn both that as well as the hidden downsides of your mortgage, probably the one you're not thinking about, and also the similarities between your big mortgage and a magnifying class of all things. And it's quite important that we talk about leverage or the ability to borrow money against a property, because I think probably a year or two ago, I ended up writing a love letter to leverage and sharing it on the podcast. But what we should also talk about are some of the dark sides of getting that big mortgage as well. Now, Andrew, when we talk about leverage and property investment, what are we really talking about?
We're talking about the loans attached to investing in property. So it's kind of the same thing when we're talking about deposits or LVR. So the fact that you're going to put some money in, but the bank's going to put in most of the money, generally speaking, when you're investing in property.
And so I recently wrote about this in my weekly column with One Roof. And I'll tell you what I'm just going to bring up a spreadsheet, Andrew, and we can talk about it. Let's say that you buy a house and the price that you pay for it is, what is it, like $1 million, right? That's a hell of a lot of money. And let's say that you put in a deposit of, let's call it $200,000. And which means that you've got a mortgage of 800 grand. So I think we're all pretty comfortable with that. Sweet, we've got an 80% loan. Now, what's really interesting is what happens if the property market goes up by 10%. Well, now our property's not worth $1 million anymore. It's worth $1.1 billion. So our mortgage is still $800K. But what that means is that the equity in our property has gone from $200,000 to $300,000, right? So we've made $100K because the property's gone up by 10%. Now, I think we're all pretty comfortable with that math. But the important thing to say is that while your property has gone up by 10%, your equity within the property has gone from 200K up to 300K, which means you actually made a 50% return on your deposit. And so my point here is when we take out a really, really big mortgage, the market's moved by 10%, but your equity has gone up by 50%. So you got, because you took out this big mortgage, 5 times the market return. Now, that's the good thing about property. But one thing we haven't really talked about is what I like to call the mortgage magnifier, which is that the smaller the deposit you put in, the less money you put into property, the bigger that magnifying glass is. So I'll give you another example. Let's say you actually only put in a 10% deposit this time, right? So we put in 100K, we'd have a $900,000 mortgage in order to buy this $1 million property. Now, your property's gone up by 10% from $1 million to 1.1, so you made 100 grand, but your equity has gone from 100 grand to 200 grand. So you made 100% return on your deposit. So again, the market went up by 10%, but your return was 100% because you only put in 1/10 of the money.
Yeah, it makes a huge difference. And while you might look at this and think, wow, that's great. When the market goes up, I'm going to go really well. If you take the Auckland market, for example, if you take any 12-month period in Auckland's property prices, 3 out of 4 times, the house values went up. You would have won. But one of those times it went down. And remember, sometimes it'll be year on year. You might see a decrease. So anyone that bought in the last couple of years, you've felt this, right? And so you've got to think about the good, but also think about the bad and how, as Ed said before, this can magnify your losses, but also your gains.
And so if we take that exact example, let's say that the property price, we bought it for $1 million, we put in 100 grand, our mortgage is 900K. Well, if property prices go down by 10%, now your house is worth $900,000. You've got no equity in that property because your mortgage is also 900K.
So you lost all your money.
Your equity in that property has gone from $100,000 down to 0. On paper, at least, you have lost 100% of the money that you initially put into that. Now, Andrew's right that over the long term, things tend to work out. But the point is that when we think about that mortgage magnifier, often people think about the good side, but we've also got to acknowledge the other side as well about, well, what happens if property prices go down? Because a negative 10% or a 10% drop in the market, if you only put in 1/10 of the money, then Yeah, holy heck. You've lost 10 times that. Could be 100% of your money. And actually, I'll do something that I don't usually do on this show. We've actually got a really good presentation that we're doing the day that we're recording this. I'm giving a seminar in Christchurch. And when I say I mean both Andrew and I, because we're twins. We're basically... can I say we're Siamese twins? I probably can't say that.
Well, I mean, anytime I bump into someone, a listener of the show out in public, they say hello, and then the second thing they say is, "Where's Ed?"
One of the really important parts of this is the size of the magnifier is based on the amount of money you put in. So if you put a tenth of the money in, so 1 over 10, so 10% of the money, then your magnifier is 10 times. If the market goes up by 5%, then you've made a 50% return on your deposit. If the market goes up by 20%, you've made a 200% return. If you put in a third of the money, so 1 over 3, your magnifier is 3 times. If you put in a fifth of the money, so 20%, your magnifier is 5 times. So effectively, the smaller and smaller the deposit you put into a property, effectively, the more volatility you will have in your investment because the magnifier is so much larger.
And this is one of the big reasons why I like new builds, and specifically talking about as an investment right now. So if you're buying a new build investment property, you need a 20% deposit, which means that you get a 5 times multiplier. The mortgage multiplier is 5 times. If you buy
mortgage magnifier.
The mortgage magnifier is 5 times.
Which is a term that I've just made up,
exactly.
Obviously.
For an existing property, you have to have a 30% deposit. So your magnifier is only 33%. So yeah, awesome. Still great that you're getting 3 1/3 magnifier, but it's not a 5 times.
Yeah, and so I suppose what we're trying to get across here is that taking out a big mortgage is a bit of a double-edged sword. Like if you buy a property for $500,000, you put in a $100K deposit, it doubles in value. You only put in $100,000, forgetting about cash flow for a minute, but you potentially made $500,000 out of that. You're 5 times your deposit because the property doubled in value. So the market multiplied itself by 2, but my wealth multiplied itself by 5 in that case. So I'm really, really happy with that. But the opposite is true as well, that if we think about some people who purchased at the top of the market, even if you put in a 20% deposit, and the market went down by 20%, well, you put in a 20% deposit, a fifth of the money, your mortgage magnifier is 5 times, the market went down by 20%, you lost 100% of your deposit, certainly on paper in the short term. And that's the dark side of leverage that we've also got to acknowledge.
Yeah, in fact, I just met with some investors, not working with me, but working with someone else in the company just yesterday. And they put in a cash deposit for an investment property that bought off plans, and there were some delays in construction. And they've basically wiped out their entire deposit. Not quite, but they've wiped out a big chunk of their deposit. And they said, well, this isn't very good. If we get that money in the shares, we would have, we potentially could have doubled that money. And now we've got half as much money. What's the plan now? And so, of course, then we had to go through the fact that, okay, yes, remember, because you're only putting a little amount of the deposit in, you have eroded 50% of that. That is pretty drastic, but you've now got to let time take care of the market movement in the other way so that you can get that money back plus some more.
Well, just like it's easy to have that decrease, and that can happen in, for example, a year, you can also see things move around quite quickly. So, for example, I just got new data out yesterday. Over the last 7 months in Auckland, property prices have gone up 3%. So if compared to that time, if your magnifier was 5 times because you'd put in a 20% deposit, you'd probably be quite happy with the last 7 months because you would have had a 15% gain. It's a 3% market movement, but that's turned into a 15% return on the money you'd put in. So it can be, that's the whole reason we're trying to get across the point that it can be quite volatile, or the value of your investment will be quite up and down because of that magnifier. A 1% change in the market might not sound that exciting, but if you'd put in a 10% deposit as a first home buyer, a 1% movement is a 10% change in the money that you'd invested. And then you think, okay, maybe a 1% market movement is quite substantial. And I get that this is kind of maybe a little bit nerdy, but it's kind of the investment side of thinking about whether we take out a large mortgage or not. But one thing I often say to people is just to really simplify the numbers down And the big difference between people who make money in property and lose money in property is really how long you hold it. So I recently was looking at CoreLogic's most recent pain and gain numbers. So in the last 3 months of 2024, if we separate out the two groups of people, the people who sold their properties and made money, so they sold their properties for more than they'd purchased them for, and the group of people who lost money in property, so they sold their properties for less money than they bought them for, 91% of people are in the gainers. 91% of people, over 9 in 10 people, even in the middle of a downturn, actually sold their property for more than they purchased it for, and they made, on average, $255,000. And that's because they held, on average, for 9 years. Now, if we look at the 9% group, the people who lost money, so just under 1 in 10 people, on average, they lost $55,000, and they'd held their properties for only 3 years on average. So there are kind of two parts to this. There's kind of the old, hold on to your properties and wait. We need to be in it for the long term in order to get the long-term gains of property investment, and we can put some numbers around that. But it's also about saying, hey, if it's really tough at the moment, we can understand why, because if you're using a large mortgage, your returns will be more up and down. They'll be more severe. A 5% market movement might be a 25% change in the equity that you'd invested within that specific property if you'd bought with a 20% deposit. And so this is kind of putting some numbers around that.
I think the other thing to remember is it becomes even bigger when you're using the no cash needed method, where you're borrowing your deposit against an existing asset. So, for example, if you're investing in property and you don't have the 20% deposit you need in cash, it's very probable that you're going to borrow that money against your own home. And of course, the other thing to remember is how much debt is an appropriate level of debt. Now, everyone's going to be different based on their own risk appetite, but just to kind of give you some numbers around it, if you're a younger person with a lot of time before you're going to need to liquidate your investments, probably it'd be quite common to have 100% debt on your rental properties using the no cash needed method because you've got time on your side. As you get closer and closer to retirement, say you're 5 years out from retirement, at that stage you probably want to use less leverage because you don't have as much time to correct a major market change.
And so that's often where we talk about your LVR, which is basically how much are all your houses worth and how much is your debt and what is that as a percentage. So if you've got $1 million property and you've got a $600,000 mortgage, well, you've got a 60% LVR because your $600,000 mortgage over your $1 million property is 60%. And what we typically see is that over time, as you get older, your overall LVR will drop. And that's probably because when you start out and you're young, I'm going to say like myself, then you're probably going to buy properties with a lot of debt because you don't have a lot of cash. Now, over time, what's going to happen is you're probably going to pay off some of your debt. On top of that, your houses are going to go up in value. And so naturally, your debt will make up a smaller and smaller proportion of your assets. In other words, your LVR really should be going down over time, and you just want to manage that. Now, the beauty of that is if you think about the mortgage magnifier, it tends to be quite large at the start, but it really changes every single year because if property values double, for instance, and now you've got all of this equity in your property, the magnifier has gone down because your LVR position has also gone down. If that's a bit nerdy, message in and we'll talk more about, give a few more details about that. So in the past 15 minutes, you've learned how to get 5 times the returns in property, some of the hidden downsides of those big mortgages and the similarities between a big mortgage and a magnifying glass. Right, let's wrap it up there, but please don't forget to rate, review and subscribe to the podcast. It really does help us get the message out to more people. Thanks for listening to the Property Academy podcast. I'm your host, Steve McKnight.
And I'm AdRev.
We're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.